bunch of earnings coming out this week. How you doing, Dima?
Pretty good. How are you doing, Will?
Great. I got the disclaimer up, so why don't we get right to that?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. Here's the disclaimer.
All right. So what do you got going on this morning?
I think then we'll just take a look what's going on with earnings. You know, we're still in the midst of the earnings season. I think we got a bunch of them coming up. So we'll take a look there. If there are questions, you know, we're going to leave room for questions today. So if you guys have any questions about a Market Chameleon tool, maybe some kind of benchmark, data analytics, something you've seen out there, you know, as far as trading or an options chain that you think is unusual, you didn't understand, you know, it's your time to ask that question. You could either put it in the chat, Will's monitoring that, he'll read it back to me, or you could click on the link there to Zoom. It's in the chat. If you click over, you could raise your hand, we'll turn you on, then we could hear your question. You don't have to turn on your video camera, but this way you could tell us what your question is, point us to where you're looking. Those are two ways you could ask that question. Sound good, Will?
Yeah. Good point. As you're going through some housekeeping notes, we also have Jake coming on at 10 a.m. for his show, First Call. So I'll put a link also into the chat for that. You can either register, or you'll see we'll go live on YouTube. So make sure you register for the YouTube channel. So I will put that in the link as well.
Okay, awesome. So what we'll do is we'll start out taking a look at the pre-market report. These are stocks that are trading in pre-market hours. And then we'll move on to the earnings. So this here is on the pre-market report right now. We got the most active stocks, the biggest percentage gainers, the biggest percentage decliners. 72 made our percentage gainers list, 68 on our percentage decliners list. So from that perspective, it's kind of a mixed bag there. For the open, the only one I see, you know, I'm seeing is that Zillow? I think that's Zillow.
Interestingly enough, I guess Zillow reported they're stopping their home purchase program, which everyone was touting as their ability to flip the market.
Yep.
So
that's what I was going to mention. So I was reading the same. I think I was reading the same article you were, but Zillow, you know, most people know them for their search that you could search real estate, you know, properties for sale either by zip code, you know, use filters by price and so forth. But they do other things to try to generate revenue. And one of the things that they started to do was try to flip housing.
Yeah, flip houses.
And how's that going? What did they say?
Well, I heard it on Bloomberg, so I didn't get to read the article yet, but I'm assuming it's not going very well for them to stop it. And everyone was touting it as a great revenue source for them. So we'll see.
Or I think that now they're sitting on a lot of inventory, right? So it's not as easy to, you know, move out as it is to move in, I guess. So they slowed down until they could reduce their inventory and then recycle back. But again, you know, that's a different business. I don't know how Zillow can manage that. It'll be interesting to see if they do, but there are other people who have been doing it successfully. I think, like, doesn't BlackRock kind of do that? Hold.
Well, their BlackRock's process is buying homes and then acting as the landlord. Right.
And then they hold them, and then they make income from the rent. Right.
Yes.
So that's what they're doing.
Exactly.
And what did Zillow try to do? Like flip?
Zillow's literally trying to flip it. The people will call, sell them the house. They're making an analysis, and I'm not sure how they have. I mean, you know, every house is different, right? Even though one in one neighborhood sold for 400, it doesn't mean the next one is going to sell for 400 as well. You know, it could be a completely different product.
Yeah, I think that the house flipping, you know, can be tricky. It's a little bit. It might be a little bit riskier, especially with, you know, the way they're doing it. So we'll see how that. But they do. I guess what is their competitive advantage that they could?
I I would think it's data. They're
Is
seeing
it,
demands in markets, how many searches they are getting, and something that comes on below their intern. It's probably a more efficient Zillow ranking. Everyone
right,
has a Zestimate of their house, right? It's
right,
probably they're using the data and their internal data to feel that this house is a really good deal, right?
right. And I think you could go on if you're using their app, they give you their estimate of what a house is worth. So whatever their algorithm is, they take in all the data and then they produce uh, a valuation estimate what they think this house is worth. So you could go there and just see what they think your
Yeah, that's
houses
their
in your
that's
neighborhood.
their Zestimate.
Right, is estimate.
Yeah.
So yeah, but anyway, interesting story if you guys want to go read about it. Let me move on though. I'm going to use this filter to see stocks that are trading in the pre-market hours that are in the S&P 500 stock, one of the S&P 500. So using this filter here in ETF, I'm going to go to this drop down. And the first one is SPY, which is the S&P 500 ETF. By selecting it, we're going to filter out stocks that are only in the S&P 500. Okay. And as you can see, there you have a list of other ETFs, but let's just do S&P 500 for now. So these are SPY stocks. So we see here we filtered them out. 7 made our percentage gainers list. 8 made our percentage decliners list. Again, it's a mixed bag, so it looks like kind of neutral at the opening, but I think the futures actually last night, I don't know, did you see them? They were up a decent amount, not this morning. I think, maybe the headlines this morning from China's slow growth, and, tamed the futures. But last night, I think I took a look and they're up about 0.75%. And that would be, I think, our third day, up in a row, making big gains here. And just a couple notes. I think Apple might be having an event today. So keep an eye out for that. I think that they're doing talking about some new, their new products. Google might also have an event this week talking about, their products. So something to keep in mind, for this week, that a couple big tech stocks are going to be holding out events, introducing or talking about some of their new products out there. If there are no questions, well, I'm going to move on to earnings.
Yeah, we did have no questions about the pre-market. We did have a chameleon ask for a look at anything the MC is showing about Netflix coming earnings, NFLX, I think it is.
Okay, so we'll take a look at Netflix. I think it is coming up. So let me go to the, we're going to take a look at the earnings that are coming up in the next 2 weeks, see if it, Netflix comes out. So I'm going to, this is the earnings menu. I'm going to pick upcoming earnings analysis. Okay, and here, right now, I'm on a kind of summary page. We have these 4 tabs here, which, we've talked about in the past, but on this summary tab right now, I'm going to also take a look at S&P 500 stocks. So by selecting this filter up here in ETF, let's do S&P 500 stocks. And these are stocks in S&P 500 that on average trade 1,000 contracts or option contracts or more per day. And up top, these 2 boxes here, these are stocks that are expected to release earnings in the next 2 weeks. And it's kind of a small summary of where the straddles are today, or as of Friday's close. We didn't open yet. As of Friday's close, what that earnings straddle looks like, and a comparison to the actual move in the last 4 quarters. So here, and I see Netflix here, so we'll talk about it, but here, top 10 stocks here, that here are the straddles, the moves that they're implying, BKR, ALK, RF. So we see this one, the straddle is implying a move of 9.2%. So remember, straddle is when you buy a call, buy a put, you're purchasing premium in both. So you need the stock to move enough either up or down to cover the cost of that straddle. Anything above that, then it becomes profitable from the purchase price. If you're selling it, you want this move to be smaller. So we could see here last 4 quarters, the realized move, the actual move after reporting earnings on average was 1.4%, a high of 3%, low 0.2. Again, very quickly, then you could go and analyze it further. I'm seeing Netflix here. That's expected to report tomorrow after the market closes.
Yep.
So right now, straddle implying a move of 5.9%. That's from Friday's close. If we compare that to the historical moves, just in the last 4 quarters, we see on average Netflix move up or down 8.6%, high move 16.9%, the lowest move in the last 4 quarters 3.3%. But if we compare it to the average, we're sitting 2.7% below that 4-quarter average. So you got, and you see some big ones, right? Twitter, Intel is going to be reporting, IBM, UMP, Kimberly-Clark. So these are just, the top 10 for each one. The full report is over here. But let's just go down, see what else we could see from the summary page. So here, this is looking in the previous 2 weeks using the filters above, right? So S&P 500 stocks trading over 1,000 contracts on average per day. The 2 up top we talked about, these are upcoming. So they haven't reported yet. They're expected to report. And below, it shows us the stocks that already just reported in the last 2 weeks and what happened, right? So we have here, these are stocks here that the straddle prior to reporting earnings was estimating a move above historical average. Okay, so these were straddles. If we compared the straddle to the 4-quarter average, they were above. Okay, on here, these were straddles that were discounted to the historical 4-quarter average. So what happened to the stocks after reporting earnings? So we see here that this stock, STT, I think what's that, State Street? If you click on the informational sheet, it should come up. So here's State Street, right? They reported earnings and October 18th before market open. Wait, so is that today? So this is looking at today's. So let's take a look at the previous one. So PLD, you can see here, moved 0.9%. The straddle was implying to move 2.3%. So did it move more than the straddle? The answer is no. And this is what the 4-quarter average move was. So you can see here that it moved less than what the straddle was implying. A couple of them, Goldman Sachs, made bigger move than the straddle was implying, 2.5%. This move was 3.8%. So that did make a higher move than the straddle was implying. So just really quickly, you could kind of go down and take a look at what's been going on recently. And here we'll get a better summary here. So out of the S&P 500 stocks that reported earnings in the last 2 weeks, that trade over 1,000 contracts per day. Remember, this filters we're using. 60% of them, 61%, had a positive effect. What it's saying is that after they reported earnings, that day, they were up. Okay, so the stock went up after reporting earnings. On average, these stocks, we could see 14 of them, they gapped up on average 1.7%. And by the end of the day, on average, they were up 2.7%. So what this is telling me, if we're looking at the averages, that they gapped up on average, and by the end of the day, they added to their gains. Okay, so from the previous day in the morning, they gapped up, and on average, we're talking about average. On average, they gapped up around 1.7%, and on average, they added to their gains about another percent. Okay, what about the down ones? So 39% roughly after reporting earnings were down that day. Okay. So what happened on average? They're down 1.9%. And by the end of the day, on average, they're down 2.5%. So again, the ones that were down on the day, in the morning, they were down. By the end of the day, they added to the losses on average, 2.5%, but not as much as the ones that added to the gains, right? So if we looked at the drift here, on average 1%, here 0.6%. So the drift to the upside tended to be a little bit higher. Everybody see that? Differences between, hopefully, yes. So what happened to the straddles on average? So this is looking at a straddle and basically making it delta neutral, because sometimes the straddles are not exactly at the strike price. So this is adjusting the delta and saying what happened to the straddles if you bought them from the day before to after reporting earnings at the end of the day. So 36.4% of them, the straddle from the buy side was profitable. 63.6, those lost value. Okay, so let's take a look at the ones that were profitable. On average, gained 41.6%. The ones that were down, 63%, lost on average 37.9. So from this perspective, just looking at it, doing the math in my head, if you sold all the straddles right here, it was better from the sell side than the buy side. So roughly 36%, obviously you would have lost, but you could see how much they went up, versus the 63% you would have gained, but you could see how much those straddles deflated. Okay. So that's all the earnings. What if we just divided them up and said, well, what if we just did the straddles where the implied move was greater than the historical averages? And what about the implied moves where the implied moves were below the historical averages? Okay. So those, it looks to me like, the ones that were greater, where the implied moves were already greater, 37.5% of those straddles were still profitable. Okay, so the stock moved beyond those straddles. 62.5%, the move was below what the straddle was. But again, here, even with these, from the sell side, looks like a better do. What about where the straddles were undervalued relative to historical moves? Okay, so that's what we're looking at, where the straddles look cheap relative to what the stocks move historically. So here, 33% of them were gainers, 66% of those straddles were losers. The gainers on average made 35%, the losers on average lost 48%. So almost across the board here, on average, straddles were better so far from the sell side. Okay, that's if you're doing all of them. Any questions there, Will? Will, you're on mute.
Yeah, sorry about that. I had a sneeze. Nope, no questions about this. Very interesting. We did have a question about calendars.
Okay.
I don't know if it's something you want to take right now or keep going with the earnings.
Sure. What is the question?
This was from Pavel. He's like, is there a way to scan for calendars with very high volatility differential? He's looking, actually, he wants a front month high IV, way different than an outer month lower vol. So,
right.
Which obviously in earnings season could be a problem potentially, right? I mean, you can't just sell the front month vol with an event coming and buy an outer month vol and be a winner. Well, at least that's how I feel.
Right. And this is a very common mistake people make. They want to sell a higher IV and buy a lower IV, which they don't realize that it's the relative premium. And by the way, Pal, I don't know if you've been watching, I said this many times on my shows and showed the data But what people will do is say, well, they don't really understand the Black-Scholes model, right? Implied volatility is it's a value derived from the Black-Scholes model, and it's a and when you look at implied volatility, and if you're trying, especially in the calendar spread, or even around earnings, people try to trade implied volatility thinking it's telling them one thing, not realizing how the model works, because the model is this estimated model with these assumptions in there, and a lot of these assumptions are not realistic. Okay, like a stack loan gap, right? Like if you a gap in a Black-Scholes model or binomial model doesn't exist. It says it's not possible. Okay, so that's what you're dealing with. That's not even possible. So for a stock to close at $100 and to open at $97, you have to accept, when you're using the Black-Scholes model, that will never happen. Okay, but we know that's not realistic. Okay, so when you're looking, so you got to be careful when you're doing those implied vols, because people think they're getting some kind of deal when they're selling a higher implied volatility and then buying a lower implied volatility across expirations. That's not that's not really the way you would want to do the spread, because if you're doing that, you're going to be disappointed. So let's take a look at example. I think I did look at an example in SPY, but I could bring something up. Let me see if I could show this example in SPY. And this is the hardest, the mentality, it's very hard to break, and there are people coming in with assumptions. Maybe you're watching YouTube videos and somebody's telling you this. It could be from a broker that's telling you this. It could be from a broker, a very big broker, right, that you're trusting. But go derive the implied volatility yourself using the Black-Scholes or binomial. It's out there. It's public. It's been out there since, 1973 or 76, and put it in there, read the assumptions, look at the data, and you're going to realize, a lot of stuff that even people are teaching you, it's not how it works. Okay, so let me just take a look here. Maybe I could find an example. And I know that even if I say this, you might not even believe me, but this is how it works. Okay, but let's just take a look at. I'm going to just bring something up right now. I'm gonna queue up a calendar spread. Here's a calendar spread. It's over 446. All right, and I'm gonna just take a look here. So what I did was I sold the October 25 call for the 446 call, bought the November 12 call for 446. Okay. So you can see here, this is what I did. This is a calendar spread. That's what it looks like, the payout diagram. Let me just take a look at the historical data. So this is the historical data, and let's just see how this was priced. So you could see here that, on every day we're capturing it where the stock is, and these are the implied volatilities. Right, these are the implied vols every day for each one, and these were the prices. So you could see that if you bought this, sold this on this day, it's $1.91, $2.24, $1.69, $2.08. So, I'm just going to take a look here, just kind of really quickly, and see, when the let me see if it tightened up here. Maybe this won't be a good example. There's not enough data. Let me go out a little bit further out. But you could probably just see it quickly, but look at this. Here's when it's one click apart, right? 14.6, 13.6, right? So that's one click apart. look when it tightened up, right? So here, now you're less, you're 0.6. It's getting closer, right? So it's getting closer, but this is going down in value. Hopefully you guys could see it. Maybe I need to find something that inverts so you could actually see the data and see how the options actually operate. Let me see. Let me do November 19th. I'm going to try to find a better example. Okay. 446. Let's do the 446. What's an expiration that's been out there a while? December 17th, maybe?
Yeah.
446. So I'm showing you the actual data. You don't have to believe me, you can just look at the actual data. That's what I'm trying to show. And obviously you could do whatever you want to do. We don't care. Like, you could scan it. We have no problem with it, but I'm just showing you for, your own benefit. So here again, this is the sell side. This is the buy side. And we're only looking at the implied vols, right? So we're looking at the implied vols where I'm going to try to find something that's maybe inverted. So you're looking for this above this. Let me see if I could find one here. So, I mean, this is where they're the closest so far, I see, right? Less than 0.6 clicks, right? Let's just compare that to where the furthest, so here's 0.6 clicks away, right? Here, they're 0.8 clicks away. So by your theory, right, we would be buying this, selling this. Let me see. I need to find something that's inverted, because you want this inverted with this. I just need to find it somewhere here, kind of just show you. Just to save time,
He was actually asking for a scan. Is there any way to scan for that?
No, we don't have a scan for that. But what I'm saying is, if your thesis is that you should automatically sell when this is above this, you should automatically sell this and buy this.
Yeah, you're going to get yourself in trouble.
Relative premiums. You're going to get yourself in trouble. So I'm just creating a scan that you're just getting yourself in trouble without actually going there and looking at their relative premiums. So that's why, I don't see the point of that scan. And if you, and it's no problem, because even if you find that scan somewhere else and use it there, I would rather you do it there and learn your lesson than here. You know what I mean? Like, I have no problem. It wouldn't be hard for me to create that scan, right? Because we have all the data, and that scan would be easy to create. But I would rather you than use somebody else's, because I don't think that you're going to be happy with the result. That's why not that I want to hold back, just because I know how the Black-Scholes model works. Let me try to see if I could find it within here just to show you an example, but just to save time, I'll find one and I'll show you in the next show. I think I've done this before and we talked about it. So if you go to previous shows on calendar spreads, I've shown it, but
I think one of the chameleons, John Miller, was saying he actually watched an episode last night where you discussed this topic.
Yeah, and it's definitely very important. Yeah, because I know you guys want to scan for it and you're like desperate, you're convinced, but before you do that, you should go get the information, go get the data. You get all, before you get all excited and you think that this is you should look at the information data, because before you commit money and capital to it, make sure, so what do you want to do? What you're trying to do is trade implied vols. So you should know as much about implied vols as you can, right? Because that's what you're trading. And go read the Black-Scholes, go read the binomial. You could derive it, and you'll understand that in a volatile environment where you have stocks that are gapping up and down, It does not work. And the binomial model assumes you're trading a certain way, where you're trading delta neutral, you're hedging. You have to take all those assumptions, and then you'll understand, like, oh, wait a minute, I need to do some more work here. It's not exactly what I was thinking it does. Okay. So, because otherwise the markets would never invert, right? If there was an arbitrage or like this great opportunity, you would never, they're inverting for a reason, right? They're inverting like that for a reason. They're lining up like that for a reason. So you need to understand it. So, I can't find that example right now.
Well, listen, we'll leave everyone wanting more show tomorrow. So listen, everyone come back. Dee will find an example for tomorrow. We also had a question about your favorite options book. So we're going to leave that for tomorrow too. Dee will answer his favorite options book tomorrow. We're at 9:31. We have a show with Jake in half an hour. So make sure you turn in for that. Great job, Dima. Thank you.
Okay. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
All right. For some of you, I'll see you in half an hour. For others, tomorrow morning, 9 a.m.